Question 1. The review process indicates that the insurance company is exploring the use of advanced data analytics to enhance its anti-money laundering AML compliance program. The proposed analytics involve analyzing customer transaction data, policyholder information, and claims data to identify suspicious patterns and potential fraud. To ensure compliance with U.S. federal and state insurance regulations, which of the following approaches to data analytics for AML compliance is most appropriate? Option A. Grant broad access to all customer transaction, policyholder, and claims data for the analytics team to perform comprehensive analysis, assuming that the team is trained in data security. Option B. Implement data analytics solutions that utilize anonymized and aggregated data with strict access controls and audit trails to identify compliance risks and suspicious activities without direct access to personally identifiable information, PI. Option C. Limit data analytics to only predefined reports generated by the core systems, which do not allow for ad hoc analysis or the identification of novel suspicious patterns. Option D. Outsource the entire data analytics function to a third-party vendor with minimal oversight, relying on their stated compliance with data privacy standards. The correct answer is B. Implement data analytics solutions that utilize anonymized and aggregated data with strict access controls and audit trails to identify compliance risks and suspicious activities without direct access to personally identifiable information, PI. Explanation. This scenario is professionally challenging because it requires a compliance professional to balance the potential benefits of advanced data analytics with the stringent requirements of data privacy and security regulations. The CICP designation implies a deep understanding of U.S. insurance regulatory frameworks, which are increasingly focused on protecting consumer data. The challenge lies in identifying and mitigating risks associated with using data analytics for compliance monitoring without inadvertently violating these regulations. The correct approach involves a proactive, risk-based strategy that prioritizes data anonymization and de-identification techniques before data is used for analytics. This aligns with the principles of data minimization and purpose limitation often embedded in U.S. privacy laws, such as those influenced by HIPAA for health insurance data or state-specific privacy laws like the California Consumer Privacy Act, CCPA, as it applies to insurance entities. By focusing on aggregated and anonymized data, the compliance team can gain insights into compliance trends and potential risks without exposing sensitive personal information, thereby fulfilling their duty to protect consumer data while enhancing compliance oversight. This approach demonstrates a commitment to both regulatory adherence and ethical data handling. An incorrect approach that relies solely on broad data access without robust anonymization or de-identification mechanisms poses significant regulatory and ethical risks. This could lead to violations of data privacy laws, resulting in substantial fines, reputational damage, and loss of consumer trust. Another incorrect approach, which involves limiting data analytics to only the most basic, predefined reports, fails to leverage the full potential of data analytics for proactive compliance monitoring and risk identification. This can lead to missed compliance issues and a less effective compliance program, potentially falling short of the reasonable steps expected by regulators to ensure compliance. Finally, an approach that outsources data analytics without stringent oversight and contractual agreements regarding data security and privacy can create a compliance gap. The responsibility for data protection ultimately rests with the insurance entity, and failure to ensure third-party compliance can lead to regulatory penalties. Professionals should adopt a decision-making process that begins with a thorough understanding of applicable U.S. data privacy regulations and insurance laws. This involves identifying the specific data types involved, the potential risks associated with their use, and the available anonymization and de-identification techniques. A risk assessment should then guide the selection of analytical methods, prioritizing those that minimize data exposure. Continuous monitoring of regulatory changes and best practices in data analytics for compliance is also crucial. Question 2. Risk assessment procedures indicate that the insurer's current written policies and procedures for handling customer complaints are outdated and do not fully address recent changes in consumer protection regulations. Which of the following approaches to rectifying this situation is most aligned with best practices for a certified insurance compliance professional? Option A. Prioritize the review and revision of consumer complaint policies based on the identified regulatory gaps and potential impact on customer trust and operational efficiency, involving relevant internal departments in the process. Option B. Immediately engage external legal counsel to redraft all consumer complaint policies from scratch, without significant internal review until finalization. Option C. Obtain a generic set of consumer complaint policies from a trade association and adapt them minimally to fit the insurer's basic operational structure. Option D. Implement a policy of only updating consumer complaint procedures when a formal regulatory inquiry or significant customer lawsuit arises. Correct answer is B. Immediately engage external legal counsel to redraft all consumer complaint policies from scratch, without significant internal review until finalization. Explanation. This scenario presents a common challenge for compliance professionals, balancing the need for comprehensive policy development with the practical realities of resource limitations and the dynamic nature of regulatory environments. The core difficulty lies in ensuring that written policies and procedures are not only compliant with current regulations, but also adaptable to future changes and effectively implemented across the organization. A robust approach requires a systematic and risk-based methodology, rather than a reactive or superficial one. The correct approach involves a systematic, risk-based review and update process for all written policies and procedures. This means identifying areas of highest regulatory exposure and operational impact first, and then developing or revising policies to address those risks. It also necessitates a clear schedule for regular review and a mechanism for incorporating feedback from operational staff and emerging regulatory guidance. This aligns with the fundamental principles of insurance regulation, which mandate that insurers maintain sound compliance management systems, including written policies and procedures that are adequate to ensure adherence to all applicable laws and regulations. The CICP framework emphasizes proactive risk management and the establishment of a strong compliance culture, which is directly supported by well-defined and regularly updated policies. An incorrect approach would be to solely rely on external legal counsel to draft policies without internal input or a thorough understanding of the company's specific operations. This fails to ensure that policies are practical, implementable, and truly address the organization's unique risks. It also neglects the internal responsibility for compliance oversight. Another incorrect approach is to only update policies when a specific regulatory violation occurs. This reactive stance is insufficient for proactive compliance and demonstrates a failure to anticipate and mitigate risks, which is a core tenet of effective compliance programs. Finally, adopting a copy-paste method from other organizations' policies without tailoring them to the specific business model and regulatory landscape of the insurer is a significant compliance failure. This approach ignores the unique operational context and regulatory nuances that each insurer faces, potentially leading to policies that are either overly burdensome or inadequate. Professionals should approach policy development and maintenance by first conducting a comprehensive risk assessment to identify key compliance areas. This assessment should inform the prioritization of policy development and revision. Following this, a structured process for drafting, reviewing, involving relevant stakeholders, approving, disseminating, and regularly auditing policies and procedures should be established. A commitment to ongoing training and a feedback loop for policy effectiveness are also crucial components of a sound compliance program. Question 3. Assessment of the most effective compliance strategy for an insurance company integrating a new third-party administrator, TPA, responsible for processing policyholder claims and managing sensitive personal information, considering the need to ensure adherence to all applicable state and federal insurance regulations and data privacy laws. Option A. Rely on the TPA's existing certifications and reputation within the industry as sufficient evidence of their compliance capabilities, without conducting independent verification. Option B. Implement a comprehensive vendor management program that includes rigorous due diligence, clearly defined contractual obligations for data security and compliance, and ongoing monitoring and auditing of the TPA's performance and adherence to regulatory requirements. Option C. Develop a contract with the TPA that broadly outlines general expectations for data handling, but lacks specific clauses on data security protocols, breach notification procedures, and audit rights. Option D. Prioritize the rapid integration of the TPA to achieve operational efficiencies, assuming that their established business practices will inherently meet compliance standards. The correct answer is B. Implement a comprehensive vendor management program that includes rigorous due diligence, clearly defined contractual obligations for data security and compliance, and ongoing monitoring and auditing of the TPA's performance and adherence to regulatory requirements. Explanation. This scenario presents a common implementation challenge in vendor management within the insurance industry, specifically concerning the integration of a new third-party administrator, TPA, that handles sensitive policyholder data. The challenge lies in balancing the operational efficiency gained from outsourcing with the paramount regulatory obligation to protect consumer data and ensure fair treatment of policyholders. The CICP professional must navigate potential conflicts between the TPA's existing processes and the insurer's compliance requirements, ensuring that the TPA's operations align with all applicable state and federal insurance laws, data privacy regulations, and ethical standards. The correct approach involves a comprehensive due diligence process that extends beyond initial vetting to include ongoing monitoring and robust contractual safeguards. This approach is right because it directly addresses the core compliance responsibilities of an insurer when engaging a third party. Specifically, it aligns with regulatory expectations that insurers retain ultimate responsibility for the actions of their vendors, particularly concerning data security, privacy, and claims handling. Regulatory frameworks, such as those promulgated by NAIC, National Association of Insurance Commissioners, model laws on third-party administrator oversight and data security, mandate that insurers conduct thorough due diligence, establish clear contractual terms, and implement ongoing monitoring to ensure vendor compliance. Ethically, this approach upholds the insurer's duty of care to policyholders by proactively mitigating risks associated with data breaches or improper claims handling by the TPA. An incorrect approach would be to rely solely on the TPA's self-attestation of compliance without independent verification. This is a regulatory failure because it abdicates the insurer's responsibility for oversight and fails to meet the due diligence requirements mandated by regulators. It creates a significant risk of non-compliance if the TPA's internal controls are inadequate or if they misinterpret regulatory obligations. Another incorrect approach would be to prioritize speed of integration over thoroughness, assuming that the TPA's established reputation is sufficient. This is an ethical and regulatory failure because it prioritizes business expediency over the protection of policyholder data and rights. A vendor's reputation does not guarantee ongoing compliance, and a failure to conduct proper due diligence can lead to significant penalties and reputational damage for the insurer. A third incorrect approach would be to implement a contract that is vague on data security and compliance responsibilities, leaving room for interpretation. This is a regulatory failure, as it fails to establish clear lines of accountability and may not adequately address specific compliance requirements related to data privacy, e.g., HIPAA, state-specific privacy laws, or claims handling standards. Such ambiguity can lead to disputes and compliance gaps. The professional decision-making process for similar situations should involve a risk-based approach. First, identify the critical functions being outsourced and the associated regulatory and ethical risks. Second, conduct thorough due diligence on potential vendors, including their compliance programs, security protocol, and financial stability. Third, establish clear, comprehensive contractual terms that define responsibilities, data protection measures, audit rights, and breach notification procedures. Fourth, implement ongoing monitoring and regular audits to ensure continued vendor compliance. Finally, maintain open communication channels with vendors and be prepared to take corrective action if compliance issues arise. Question 4. Upon reviewing the insurer's compliance program for a new product launch, the compliance officer notes that the product's disclosures align with the latest NAIC Model Act on a particular subject. However, the officer is aware that the insurer operates in multiple states, each with its own insurance department. What is the most appropriate approach to ensure regulatory compliance for this new product's disclosures? Option A. Focus solely on the most recent NAIC guidance, assuming that state regulators will align their enforcement with these updated recommendations. Option B. Rely on the insurer's internal compliance policies, which were developed based on NAIC guidance, to ensure adherence to disclosure requirements. Option C. Verify the specific statutes and regulations in each state where the insurer is licensed to operate and compare them against the NAIC Model Act, noting any state-specific variations or adoptions. Option D. Assume that compliance with the latest NAIC Model Act is sufficient for all states, as NAIC models are generally considered best practices. The correct answer is C. Verify the specific statutes and regulations in each state where the insurer is licensed to operate and compare them against the NAIC Model Act, noting any state-specific variations or adoptions. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of how the National Association of Insurance Commissioners, NAIC, model laws and guidelines are adopted and implemented at the state level, and how deviations from these models can impact compliance. A compliance professional must not only be aware of the NAIC recommendations, but also the specific legislative and regulatory landscape of each state in which the insurer operates. The core of the challenge lies in balancing the desire for uniformity and best practices promoted by the NAIC with the sovereign authority of individual states to enact their own insurance laws. Correct approach involves a thorough review of the specific state statutes and regulations that govern the insurer's operations, comparing them against the relevant NAIC model laws and guidance. This approach is correct because state insurance departments are the primary regulators, and their laws supersede NAIC model laws if there is a conflict or if the state has not adopted the model law. The NAIC role is to provide model frameworks and facilitate uniformity, but adoption and enforcement are state-specific. Therefore, ensuring compliance with the actual enacted laws and regulations of each relevant state is paramount. This aligns with the fundamental principle of insurance regulation in the U.S., which is state-based. An incorrect approach would be to assume that adherence to the NAIC model law automatically equates to compliance in all states. This is a regulatory failure, because it ignores the state-specific nature of insurance regulation. States may adopt NAIC model laws with modifications, or they may choose not to adopt them at all. Relying solely on the NAIC model without verifying state adoption and specific variations can lead to noncompliance with state laws, resulting in potential fines, sanctions, or reputational damage. Another incorrect approach would be to prioritize the insurer's internal policies and procedures over the actual regulatory requirements, even if those internal policies were developed with NAIC guidance in mind. This is an ethical and regulatory failure because internal policies, while important for operational consistency, do not replace the legal obligations imposed by state regulators. The ultimate authority rests with the state insurance departments. A third incorrect approach would be to only consider the most recent NAIC guidance without verifying if that guidance has been incorporated into state laws or regulations. Regulatory frameworks evolve, and while NAIC guidance often reflects current best practices, its legal enforceability is contingent upon state adoption. The professional decision-making process for similar situations should begin with identifying the relevant jurisdictions for the insurer's operations. For each jurisdiction, the compliance professional must then research and obtain the specific statutes and regulations governing the area in question. This should be followed by a comparative analysis against relevant NAIC model laws and guidance. Any discrepancies or areas where the state has not adopted the NAIC model or has adopted it with modifications must be carefully documented and addressed to ensure full compliance with state-specific requirements. Question 5. Strategic planning requires the board of directors of an insurance company to evaluate a potential acquisition. The acquisition promises significant short-term cost savings and a quick boost to market share. However, preliminary due diligence suggests potential integration challenges and a less-than-perfect alignment with the company's long-term strategic vision. One senior executive strongly advocates for immediate approval, citing the urgent need to meet quarterly financial targets. What is the most appropriate decision-making framework for the board to adopt in this situation, adhering to the principles of corporate governance and compliance? Option A. Approve the acquisition immediately based on the senior executive's recommendation to meet quarterly financial targets and secure immediate cost savings. Option B. Prioritize the immediate revenue generation and market share increase, assuming that any integration or compliance issues can be addressed reactively after the deal is closed. Option C. Conduct a thorough strategic review of the acquisition's long-term fit, perform comprehensive risk assessments, and ensure full compliance with all relevant insurance regulations before making a final decision. Option D. Rely solely on the senior executive's assessment and the projected short-term revenue gains, deferring any deeper strategic or compliance review until after the acquisition is complete. Correct answer is C. Conduct a thorough strategic review of the acquisition's long-term fit, perform comprehensive risk assessments, and ensure full compliance with all relevant insurance regulations before making a final decision. Explanation: this scenario is professionally challenging because it involves a conflict between immediate financial pressures and long-term strategic objectives, requiring a decision that balances stakeholder interests and regulatory compliance. The board must navigate potential reputational damage and legal repercussions if they prioritize short-term gains over sound corporate governance principles. The correct approach, which involves a comprehensive review of strategic alignment and risk assessment before approving the acquisition, is right because it adheres to fundamental principles of corporate governance and fiduciary duty. This approach ensures that decisions are made in the best long-term interest of the company and its shareholders, supported by thorough due diligence and consideration of all relevant factors, including regulatory compliance and ethical implications. This aligns with the core tenets of the Certified Insurance Compliance Professional (CICP) framework, which emphasizes responsible decision-making and adherence to legal and ethical standards. An incorrect approach that prioritizes immediate cost savings without a full strategic review fails to uphold the board's fiduciary duty. This could lead to the acquisition of an underperforming or non-compliant entity, exposing the company to unforeseen risks and potential regulatory sanctions. Such a decision would likely violate principles of prudent management and could be seen as a breach of trust by shareholders. Another incorrect approach, which relies solely on the recommendation of a single executive without independent verification, bypasses essential checks and balances inherent in good corporate governance. This creates an unacceptable level of reliance on one individual's judgment, increasing the risk of oversight, bias, or even misconduct. It undermines the collective responsibility of the board and the principle of independent oversight. A third incorrect approach, which focuses only on the potential for short-term revenue generation without considering the long-term strategic fit or integration challenges, is also professionally unacceptable. This narrow focus ignores the broader implications of the acquisition on the company's market position, operational efficiency, and regulatory standing. It represents a failure to engage in holistic strategic planning and risk management. A professional decision-making process for similar situations should involve a structured framework, clearly define the strategic objective, identify all relevant stakeholders and their interests, gather comprehensive information and conduct thorough due diligence, assess all potential risks and benefits, consider alternative courses of action, consult with legal and compliance experts, and document the decision-making process meticulously. This ensures that decisions are informed, defensible, and aligned with regulatory requirements and ethical standards. Question 6. Performance analysis shows a significant increase in the number of customer complaints related to policy cancellations and a moderate increase in complaints regarding claims processing delays. The compliance department is tasked with designing the next internal audit plan. Which of the following approaches would be the most effective and compliant strategy for monitoring and auditing these areas? Option A. Prioritize auditing departments that have had significant audit findings in the past 2 years, irrespective of current complaint trends. Option B. Conduct a targeted audit focusing on the root causes of policy cancellation issues, given their higher volume of complaints, and a separate, less intensive review of claims processing procedures. Option C. Audit only the claims department, as delays are a more direct indicator of potential regulatory breaches than customer complaints about cancellations. Option D. Perform a comprehensive, file-by-file review of all recent policy cancellations and claims processing activities to ensure absolute accuracy. The correct answer is B. Conduct a targeted audit focusing on the root causes of policy cancellation issues, given their higher volume of complaints, and a separate, less intensive review of claims processing procedures. Explanation: scenario analysis. This scenario presents a common challenge in insurance compliance, identifying and addressing potential systemic issues through effective monitoring and auditing. The challenge lies in moving beyond superficial checks to uncover root causes of noncompliance, which can have significant financial and reputational consequences. A compliance professional must exercise careful judgment to select the most appropriate audit strategy that balances thoroughness with efficiency, ensuring that the audit provides actionable insights rather than just a report of findings. Correct approach analysis. The correct approach involves a risk-based audit methodology. This means prioritizing audit areas based on their potential impact on regulatory compliance, financial stability, and customer protection. A risk-based audit would involve a preliminary assessment to identify high-risk areas, followed by detailed testing of those areas. This approach is justified by regulatory frameworks that emphasize proactive risk management and the efficient allocation of compliance resources. For example, the NAIC model laws and state-specific regulations often require insurers to have robust internal control systems designed to identify and mitigate risks, including compliance risks. A risk-based audit directly supports this requirement by focusing on where the greatest risks lie. Incorrect approaches analysis, focusing solely on the most frequent types of customer complaints, without considering the underlying regulatory implications or the volume of transactions in those areas, is an insufficient approach. While complaints are important indicators, they may not always reflect the most significant compliance risks. For instance, a high volume of minor complaints might distract from a lower volume of potentially more serious regulatory breaches in another area. This approach fails to align with the risk-based principles mandated by many insurance regulations, which require a systematic assessment of potential harm. Auditing only those departments with a history of past audit findings, without considering current operational changes or emerging regulatory requirements, is also inadequate. Compliance risks are dynamic. New products, market shifts, or changes in regulatory interpretation can create new areas of noncompliance. An audit strategy that relies solely on historical data risks missing current or future compliance failures. This neglects the proactive nature of compliance monitoring expected by regulators. Conducting a comprehensive line-by-line review of all policyholder files, regardless of risk assessment, is often impractical and inefficient. While thoroughness is important, an audit must be strategic. Such an approach consumes excessive resources and may not yield proportionate compliance benefits compared to a targeted risk-based methodology. It fails to demonstrate efficient use of compliance resources, which is an implicit expectation in regulatory oversight. Professional reasoning. Professionals should adopt a risk-based approach to monitoring and auditing. This involves 1. Identifying potential compliance risks across all business operations. 2. Assessing the likelihood and impact of each identified risk. 3. Prioritizing audit efforts on the highest risk areas. 4. Developing audit plans that are proportionate to the identified risks. 5. Regularly reviewing and updating the risk assessment and audit plan to reflect changes in the business environment and regulatory landscape. This systematic process ensures that compliance resources are deployed effectively to protect the organization and its stakeholders. Question 7. Implementation of a new commercial property insurance placement for a large manufacturing client necessitates exploring coverage options beyond the admitted market due to unique risk exposures. The client has expressed a preference for a specific non-admitted insurer they have previously worked with. What is the most compliant and professionally responsible approach for the insurance intermediary to take in this situation? Adhering strictly to U.S. state-based surplus lines regulations. Option A. Place the coverage with the non-admitted insurer based on the client's request, assuming that if the insurer is operating in the market, it must be compliant. Option B. Inform the client that coverage can only be placed in the admitted market, as surplus lines insurance involves too many regulatory complexities and potential risks. Option C. Conduct thorough due diligence on the preferred non-admitted insurer, verifying its domiciliary licensing, financial solvency through reputable rating agencies, and its authorization to transact surplus lines business in the state where the policy is being placed, before finalizing the placement. Option D. Proceed with placing the coverage with the client's preferred non-admitted insurer, as the client has prior experience and the intermediary is licensed as a surplus lines broker in the relevant state. Correct answer is D. Proceed with placing the coverage with the client's preferred non-admitted insurer, as the client has prior experience and the intermediary is licensed as a surplus lines broker in the relevant state. Explanation. This scenario presents a professional challenge because surplus lines insurance, by its nature, operates outside of the standard admitted market regulations. This means that while it offers flexibility and access to specialized coverages, it also carries inherent risks for consumers and requires a heightened level of diligence from intermediaries to ensure compliance and consumer protection. The challenge lies in balancing the unique characteristics of the surplus lines market with the overarching principles of fair dealing, solvency, and regulatory oversight that govern the insurance industry. Compliance professional must navigate the specific state-by-state regulations governing surplus lines, which can vary significantly, while also adhering to broader ethical obligations. The correct approach involves a thorough understanding and application of the specific state's surplus lines laws, including diligent due diligence on the eligible surplus lines insurer. This includes verifying the insurer's licensing status in its home jurisdiction, assessing its financial solvency through publicly available information or rating agency reports, and confirming it is authorized to transact surplus lines business in the state where the policy is being placed. This approach is correct because it directly addresses the core regulatory requirements designed to protect consumers by ensuring that coverage is placed with financially sound and legally authorized entities. It aligns with the principle of ensuring that even non-admitted insurance meets a minimum standard of security and legitimacy. An incorrect approach that relies solely on the insured's request for a specific non-admitted insurer without independent verification fails to meet the compliance professional's duty of care. This is a regulatory failure because it bypasses the mandated due diligence process designed to safeguard against placing business with insolvent or unauthorized insurers, thereby exposing the insured to potential financial loss. Another incorrect approach that involves assuming compliance based on the existence of a surplus lines broker's license, without verifying the specific insurer's eligibility and financial standing for the particular risk, is also a regulatory failure. The broker's license permits them to operate in the surplus lines market, but it does not absolve them of the responsibility to ensure each placement is compliant and with a sound insurer. Finally, an approach that prioritizes speed of placement over thorough due diligence, by neglecting to confirm the insurer's domiciliary licensing and financial stability, constitutes a significant regulatory and ethical failure. This approach prioritizes business expediency over consumer protection and regulatory adherence, which is fundamentally contrary to the objectives of surplus lines regulation. Professionals should employ a decision-making framework that begins with identifying the specific state's surplus lines laws applicable to the transaction. This is followed by a systematic process of due diligence on the proposed surplus lines insurer, confirming its eligibility, financial stability, and authorization. Any deviation from this rigorous process, particularly when it compromises consumer protection or regulatory compliance, should be immediately flagged and rectified. Question 8. Which approach would be most compliant with regulatory requirements and ethical obligations when a client expresses a strong preference for the most inexpensive homeowner's insurance policy available, despite the property having unique characteristics that may increase its risk profile? Option A. Recommend a standard low-cost policy without inquiring further about the property's specific features or the client's unique needs, based on the client's stated preference for affordability. Option B. Advise the client that the cheapest policy is likely sufficient for their needs and that additional coverage is unnecessary, focusing on the immediate cost savings. Option C. Conduct a comprehensive risk assessment of the property, clearly explain the coverage provided by various policy options, including limitations and exclusions, and guide the client towards a policy that appropriately matches their identified risks and budget. Option D. Immediately present the lowest cost policy options available, emphasizing the savings, and assume the client understands the implications of choosing a less comprehensive coverage. The correct answer is C. Conduct a comprehensive risk assessment of the property, clearly explain the coverage provided by various policy options, including limitations and exclusions, and guide the client towards a policy that appropriately matches their identified risks and budget. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated needs and the potential for misrepresentation or misunderstanding of policy coverage, particularly in the context of homeowners insurance, where specific perils and exclusions are critical. Navigating this requires a deep understanding of regulatory requirements for disclosure, fair dealing, and accurate policy placement, ensuring the client receives appropriate coverage without misleading them or the insurer. The correct approach involves a thorough needs analysis that goes beyond the client's initial statements. This includes actively probing for details about the property's construction, location, any unique risks, e.g., home business, specific valuables, and past claims history. The professional must then explain the available coverage options, clearly outlining what is included and, crucially, what is excluded under a standard homeowner's policy. This proactive disclosure and educational approach aligns with regulatory mandates for transparency and suitability, ensuring the client makes an informed decision based on accurate information about their risks and the policy's limitations. This upholds the ethical duty to act in the client's best interest and comply with fair claims and underwriting practices. An incorrect approach that focuses solely on the client's stated desire for the cheapest available policy without further investigation fails to meet the duty of care. This could lead to underinsurance or coverage gaps, potentially resulting in significant financial hardship for the client if a claim arises. Such an approach risks violating regulations requiring insurers and agents to ensure policies are suitable for the client's needs and that all material facts are disclosed. Another incorrect approach that involves recommending a policy based on assumptions about the client's risk profile without verification is equally problematic. This can lead to misrepresentation on the application and inappropriate underwriting, which can result in policy rescission or denial of claims. This violates principles of accurate risk assessment and fair representation to the insurer. Finally, an approach that prioritizes closing the sale quickly by downplaying potential exclusions or limitations, even if not explicitly lying, can be considered misleading. This erodes trust and can lead to client dissatisfaction and regulatory scrutiny for deceptive practices. The professional decision-making process in such situations should involve a structured needs assessment, clear communication of policy terms and limitations, documentation of discussions and recommendations, and a commitment to placing the client in coverage that genuinely meets their identified risks and exposures, in compliance with all applicable regulations. Question 9. The analysis reveals that a company's group health insurance plan, administered by a third-party administrator, has not had its summary plan description, SPD, updated in 5 years, and participant privacy policies have not been formally reviewed against current HIPAA regulations in 3 years. Which of the following approaches best ensures ongoing compliance with federal group health insurance regulations? Option A. Assume that the lack of participant complaints indicates the plan is compliant with all regulatory obligations. Option B. Prioritize cost-effectiveness by maintaining the current administrative arrangements, as any changes would likely increase expenses. Option C. Continue relying on the third-party administrator to manage all aspects of compliance, assuming their expertise covers regulatory updates. Option D. Conduct a comprehensive review of all plan documents and administrative processes against current ERISA and HIPAA requirements, and implement necessary updates and training. The correct answer is C. Continue relying on the third-party administrator to manage all aspects of compliance, assuming their expertise covers regulatory updates. Explanation. This scenario presents a common challenge in group health insurance compliance, balancing the need for efficient plan administration with the imperative to adhere to stringent regulatory requirements designed to protect plan participants. The professional challenge lies in interpreting and applying complex regulations to a dynamic business environment, where operational efficiency can sometimes create unintended compliance gaps. Careful judgment is required to ensure that administrative practices do not inadvertently lead to discriminatory outcomes or a failure to provide required disclosures. The correct approach involves a proactive and systematic review of all group health insurance plan documents and administrative processes against the relevant regulatory framework, specifically focusing on the Employee Retirement Income Security Act (ERISA) and the Health Insurance Portability and Accountability Act (HIPAA), as they apply to group health plans. This includes verifying that summary plan descriptions (SPD) are accurate, comprehensive, and distributed in a timely manner, and that all privacy and security policies are robust and consistently enforced. This approach is correct because it directly addresses the core compliance obligations under ERISA and HIPAA, ensuring participant rights and protections are upheld. It demonstrates a commitment to best practices by embedding compliance into the operational fabric of the plan. An incorrect approach would be to rely solely on the fact that a third-party administrator, TPA, is managing the plan. While TPAs handle many administrative functions, the ultimate responsibility for compliance rests with the plan sponsor. Delegating compliance without adequate oversight is a significant regulatory failure. Another incorrect approach is to assume that because a plan has been in place for a long time without issues, it remains compliant. Regulations evolve, and plan documents and practices must be periodically reviewed and updated to reflect current legal requirements. Failing to do so can lead to noncompliance with new or amended rules. A further incorrect approach is to prioritize cost savings over compliance by choosing administrative vendors or processes that offer lower costs but do not meet regulatory standards for disclosure, privacy, or participant rights. This prioritizes financial expediency over legal and ethical obligations, which is a clear regulatory and ethical failure. The professional reasoning process for similar situation should involve a multi-step approach. First, identify all applicable federal and state regulations governing the specific type of group health plan. Second, conduct a thorough internal audit of all plan documents, communications, and administrative procedures. Third, engage with legal counsel or compliance experts to interpret complex regulatory requirements and assess the plan's adherence. Fourth, implement necessary corrective actions and establish ongoing monitoring mechanisms to ensure sustained compliance. Finally, foster a culture of compliance within the organization, emphasizing the importance of participant rights and regulatory adherence. Question 10. The audit findings indicate that the current anti-money laundering (AML) training program for insurance company employees is insufficient in addressing emerging typologies of financial crime and lacks a robust mechanism for assessing employee comprehension. Which of the following actions represents the most appropriate and compliant response to these findings? Option A. Update the AML training content to incorporate current regulatory guidance and emerging financial crime risks. Implement a more rigorous assessment of employee understanding through scenario-based testing, and enhance the tracking of training completion and effectiveness. Option B. Reassign the responsibility for developing and delivering AML training to the sales department, assuming they have the most direct contact with customers and thus the best understanding of relevant risks. Option C. Focus exclusively on increasing the frequency of AML training sessions without revising the core content or assessment methods to demonstrate a heightened commitment to AML compliance. Option D. Conduct a superficial review of the existing AML training materials and make minor edits to reflect recent regulatory updates, while continuing to rely on basic attendance records as proof of compliance. The correct answer is A. Update the AML training content to incorporate current regulatory guidance and emerging financial crime risks. Implement a more rigorous assessment of employee understanding through scenario-based testing, and enhance the tracking of training completion and effectiveness. Explanation. The audit findings indicate a potential gap in the insurance company's compliance program, specifically concerning employee training on anti-money laundering (AML) regulations. This scenario is professionally challenging because it requires the compliance officer to balance the immediate need to address the audit finding with the long-term strategic goal of embedding a robust compliance culture. The officer must not only rectify the immediate issue, but also ensure that the training program is effective, sustainable, and meets regulatory expectations. The correct approach involves a comprehensive review and enhancement of the existing AML training program. This includes identifying specific deficiencies highlighted by the audit, updating training content to reflect current regulatory requirements and emerging risks, and implementing a more robust delivery and tracking mechanism. This approach is right because it directly addresses the audit findings by improving the quality and effectiveness of the training, thereby mitigating future compliance risks. It aligns with the principles of a strong compliance program, which mandates regular, relevant, and documented training for all relevant personnel. Regulatory bodies, such as those overseeing insurance in the U.S., expect insurers to have proactive and effective training programs that equip employees to identify and report suspicious activities, thus preventing financial crime. An incorrect approach would be to simply acknowledge the audit finding and make minor, superficial adjustments to the training materials without a thorough review of their effectiveness or the delivery methods. This fails to address the root cause of the deficiency and leaves the company vulnerable to repeat findings and potential regulatory sanctions. Demonstrates a reactive rather than proactive compliance stance. Another incorrect approach would be to focus solely on the documentation of training completion, without ensuring the actual comprehension and application of the material by employees. While documentation is crucial for audit purposes, it does not guarantee that employees understand their AML obligations or can identify red flags. This approach prioritizes form over substance, which is a significant compliance failure. A third incorrect approach would be to delegate the entire responsibility for rectifying the training program to a single department without adequate oversight or involvement from senior management and the compliance function. Compliance is a shared responsibility, and while specific tasks can be delegated, the ultimate accountability for the effectiveness of the compliance program rests with the organization's leadership and its compliance officers. This fragmented approach can lead to inconsistencies and a lack of strategic direction in the training initiative. The professional decision-making process for similar situations should involve a systematic approach. First, thoroughly understand the audit findings and their implications. Second, assess the current state of the relevant compliance program, in this case, AML training. Third, identify specific gaps and areas for improvement based on regulatory requirements and best practices. Fourth, develop a remediation plan that includes concrete actions, timelines, and responsible parties. Fifth, implement the plan with adequate resources and oversight. And finally, monitor the effectiveness of the implemented changes and conduct periodic reviews to ensure ongoing compliance and continuous improvement. Question 11. Operational review demonstrates that a life insurance company is experiencing delays in generating long-term care insurance policy illustrations for its sales agents. The compliance department is tasked with ensuring these illustrations are not only timely, but also compliant with all applicable regulations. Which of the following approaches best ensures compliance while addressing the operational challenge? Option A. Implement a robust review process for all long-term care insurance illustrations, verifying the accuracy of benefit projections, cost disclosures, and the clarity of language used, even if this temporarily impacts the speed of generation. Option B. Focus solely on the regulatory requirement for illustrations to be delivered within a specified timeframe, assuming that the underlying actuarial assumptions used by the product development team are inherently compliant. Option C. Expedite the generation of illustrations by using pre-approved, standardized actuarial assumptions without individual policy-specific adjustments, and provide a general disclaimer about potential variations. Option D. Allow sales agents to modify standard illustration templates with their own projections, provided they obtain a signed acknowledgement from the prospective policyholder that the illustration is an estimate. The correct answer is C. Expedite the generation of illustrations by using pre-approved, standardized actuarial assumptions without individual policy-specific adjustments, and provide a general disclaimer about potential variations. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires balancing the insurer's need to manage risk and financial solvency with the regulatory mandate to ensure policyholders receive accurate and understandable information, particularly concerning long-term care insurance, which can have complex benefit structures and significant financial implications for consumers. The compliance professional must navigate potential conflicts between sales incentives and the duty of care to the insured. Correct approach analysis. The correct approach involves a thorough review of the policy illustrations to ensure they accurately reflect the policy's benefits, limitations, and potential costs, and that these are presented in a manner that is clear and understandable to the prospective policyholder. This aligns with regulatory requirements that prohibit misleading or deceptive advertising and sales practices, and emphasizes the insurer's obligation to act in good faith. Specifically, regulations often require that illustrations be based on reasonable assumptions and clearly disclose any limitations or contingencies that could affect benefit payouts. The focus on clarity and accuracy in illustrations directly supports the consumer's ability to make an informed decision, a core principle of insurance regulation. Incorrect approaches analysis. An approach that prioritizes the speed of illustration generation over accuracy and clarity would be professionally unacceptable. This failure would violate regulations prohibiting misleading sales materials and could lead to policyholders misunderstanding their coverage, potentially resulting in financial hardship and regulatory action against the insurer. An approach that allows illustrations to be generated using overly optimistic or unsubstantiated actuarial assumptions without clear disclosure would also be a significant regulatory and ethical failure. This misrepresents the potential value and cost of the policy, undermining the informed consent process and potentially leading to claims of misrepresentation. An approach that focuses solely on meeting internal sales targets without independently verifying the accuracy and compliance of the illustrations would be a dereliction of the compliance professional's duty. This demonstrates a lack of due diligence and a failure to uphold the regulatory framework designed to protect consumers. Professional reasoning. Professionals should adopt a systematic approach to reviewing policy illustrations. This involves understanding the relevant regulatory requirements for illustrations, including disclosure mandates and permissible assumptions. They should then critically evaluate the illustration's content for clarity, accuracy, and completeness, ensuring that all potential outcomes and limitations are adequately explained. If any discrepancies or potential misrepresentations are identified, the professional must escalate these issues for correction before the illustrations are used in sales. This proactive and diligent approach ensures compliance and upholds ethical standards. Question 12. The audit findings indicate a potential discrepancy in the application of the product's completed operations hazard exclusion for a specific commercial general liability policyholder, suggesting that claims arising from completed work might not be adequately excluded. What is the most appropriate best practice approach for the compliance professional to address this finding? Option A. Immediately advise the policyholder that their coverage is likely inadequate and recommend an immediate policy amendment or endorsement to address the identified gap. Option B. Accept the auditor's interpretation at face value and recommend an adjustment to the policyholder's premium to reflect the perceived increased risk. Option C. Classify the finding as a minor administrative oversight and recommend no immediate action, assuming it will be addressed during the next policy renewal cycle. Option D. Conduct a detailed review of the specific CGL policy language, including any endorsements related to the product's completed operations hazard, and cross-reference this with relevant state insurance regulations and case law concerning the interpretation of such exclusions. The correct answer is D. Conduct a detailed review of the specific CGL policy language, including any endorsements related to the product's completed operations hazard, and cross-reference this with relevant state insurance regulations and case law concerning the interpretation of such exclusions. Explanation. This scenario presents a professional challenge because it requires the compliance professional to interpret and apply complex commercial general liability (CGL) policy language in the context of a specific audit finding, balancing the insurer's potential exposure with the policyholder's reasonable expectations and the regulatory duty to ensure fair claims handling. The challenge lies in discerning whether the audit finding represents a genuine coverage gap or a misinterpretation of policy terms that could lead to an unwarranted denial of coverage or an unnecessary premium adjustment. Careful judgment is required to avoid both underinsuring the client and exposing the insurer to undue risk. The correct approach involves a thorough review of the specific CGL policy provisions, endorsements, and relevant state insurance regulations pertaining to policy interpretation and claims handling. This approach is best professional practice because it directly addresses the audit finding by grounding the decision in the contractual obligations of the policy and the legal framework governing insurance. Specifically, it requires understanding the definitions of occurrence, bodily injury, and property damage as defined within the policy and as interpreted by applicable case law in the relevant jurisdiction. Furthermore, it necessitates an assessment of whether the insurer's underwriting and claims handling practices align with regulatory expectations for fair and accurate policy application. This ensures that coverage decisions are not arbitrary, but are based on a diligent and informed interpretation of the policy and governing laws, upholding the principles of good faith and fair dealing. An incorrect approach that focuses solely on the auditor's interpretation without independent verification fails to uphold the compliance professional's duty to ensure accurate policy application. This approach risks accepting a potentially flawed assessment, which could lead to incorrect coverage determinations, unfair treatment of the policyholder, and potential regulatory scrutiny for the insurer. Another incorrect approach that prioritizes immediate cost savings by assuming the audit finding necessitates a policy exclusion or premium increase without a detailed policy review is also professionally unacceptable. This approach disregards the contractual rights of the policyholder and the insurer's obligation to provide coverage as agreed. It can lead to disputes, regulatory complaints, and damage to the insurer's reputation. A third incorrect approach that dismisses the audit finding as a minor administrative issue without investigating its potential impact on coverage or regulatory compliance is equally flawed. This approach neglects the potential for systemic issues or significant coverage implications that may not be immediately apparent. It fails to proactively manage risk and ensure adherence to regulatory requirements. The professional decision-making process for similar situations should involve a systematic approach. First, thoroughly understand the audit finding and its context. Second, meticulously review the relevant CGL policy language, including all endorsements and exclusions. Third, research applicable state insurance laws and regulations, including any relevant case law interpreting similar policy provisions. Fourth, consult with underwriting and claims departments to gather all pertinent information and perspectives. Finally, make a reasoned determination based on the evidence, policy terms, and regulatory requirements, documenting the rationale for the decision. Question 13. The risk matrix shows a moderate likelihood of regulatory scrutiny regarding the accounting treatment of intangible assets acquired as part of a recent subsidiary purchase. The insurer's internal finance team, accustomed to GAAP, proposes capitalizing the full value of the acquired brand name and customer list, amortizing them over their estimated useful lives. As the certified insurance compliance professional, you must advise on the appropriate accounting treatment under statutory accounting principles, SAP, to ensure regulatory compliance and solvency. Which of the following approaches best aligns with SAP requirements? Option A. Defer the accounting treatment for these intangible assets until further clarification is obtained from industry accounting standard-setting bodies to avoid potential misinterpretations. Option B. Capitalize the full value of the acquired brand name and customer list and amortize them over their estimated useful lives, consistent with GAAP, to reflect the economic benefits of these assets. Option C. Expense the full value of the acquired brand name and customer list immediately upon acquisition, as SAP generally disallows or severely restricts the capitalization of such intangible assets to ensure a conservative solvency position. Option D. Seek an exception from the state insurance department to apply GAAP treatment for these specific intangible assets due to their significant economic value. The correct answer is C. Expense the full value of the acquired brand name and customer list immediately upon acquisition, as SAP generally disallows or severely restricts the capitalization of such intangible assets to ensure a conservative solvency position. Explanation. This scenario is professionally challenging because it requires a compliance professional to navigate the nuances of statutory accounting principles, SAP, in the context of financial reporting and regulatory solvency, specifically concerning the treatment of a newly acquired subsidiary's assets. The pressure to present a favorable financial position while adhering to strict regulatory requirements necessitates a deep understanding of SAP's conservative nature and its divergence from generally accepted accounting principles, GAAP. The core challenge lies in distinguishing between accounting treatments that are permissible under SAP for solvency and regulatory purposes versus those that might be acceptable under GAAP but are not. The correct approach involves recognizing that SAP prioritizes solvency and the protection of policyholders above all else. This means that assets must be valued conservatively and liabilities must be recognized promptly and fully. Specifically, the treatment of the acquired subsidiary's intangible assets, such as goodwill and brand value, under SAP is critical. SAP generally disallows or severely restricts the capitalization of such intangibles, requiring them to be expensed immediately or amortized over a very short period, if at all, to avoid overstating the insurer's financial strength. Therefore, the compliance professional must ensure that the financial statements reflect this conservative SAP treatment, even if it results in a lower reported net income or equity compared to GAAP. This aligns with the fundamental purpose of SAP, which is to provide a basis for assessing an insurer's ability to meet its obligations to policyholders. An incorrect approach would be to apply GAAP principles for the valuation and recognition of the subsidiary's intangible assets. GAAP allows for the capitalization of goodwill and other intangibles if they have a determinable useful life and provide future economic benefits. Applying GAAP in this SAP-governed context would lead to an overstatement of the insurer's assets and equity, potentially masking underlying financial weaknesses and misrepresenting the insurer's true solvency position to regulators. This directly violates the conservative principles of SAP and the regulatory mandate to protect policyholders. Another incorrect approach would be to defer the decision on the treatment of these intangible assets, waiting for further guidance or a more opportune time. This inaction creates a compliance gap and exposes the insurer to regulatory scrutiny and potential penalties. SAP requires timely and accurate financial reporting based on established principles. Delaying the appropriate SAP accounting treatment for significant assets is a failure to adhere to regulatory expectations and undermines the integrity of the financial reporting process. A third incorrect approach would be to adopt a hybrid accounting method, selectively applying SAP principles where they are most favorable and GAAP principles elsewhere. This selective application is not permissible under SAP, which mandates a consistent and comprehensive adherence to its principles for all financial reporting purposes. Such a hybrid approach would distort the financial picture and fail to provide regulators with an accurate assessment of the insurer's financial health, thereby compromising policyholder protection. The professional decision-making process for similar situations should begin with a thorough understanding of the specific SAP requirements applicable to the jurisdiction. This involves consulting the relevant state insurance department regulations and the NAIC accounting practices and procedures manual. The compliance professional must then critically assess the nature of the acquired assets, particularly intangible assets, and determine their appropriate SAP treatment. This often requires consultation with external auditors and actuaries specializing in insurance accounting. The focus should always be on conservatism and the ability of the insurer to meet its obligations, rather than on maximizing reported earnings or equity. Transparency with regulators regarding accounting treatments and any significant judgments made is also paramount. Question 14. Consider a scenario where an insurance company is required to implement significant new data security and privacy protocols mandated by recent state legislation. The compliance department has drafted a comprehensive policy document detailing these new requirements, which will impact all employees, from customer service representatives to IT personnel. What is the most effective approach to ensure all employees understand and adhere to these critical new protocols? Option A. Schedule a brief optional webinar to cover the highlights of the new policy and answer any immediate questions. Option B. Distribute the comprehensive policy document via email to all employees, followed by a mandatory, interactive training session that includes a knowledge check and a policy acknowledgement. Option C. Send a single email to all employees summarizing the key changes and providing a link to the full policy document for their review. Option D. Post the full, unedited technical policy document on the company's internal intranet and assume employees will access and understand it. The correct answer is B. Distribute the comprehensive policy document via email to all employees, followed by a mandatory, interactive training session that includes a knowledge check and a policy acknowledgement. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient communication with the absolute necessity of ensuring all employees understand critical compliance information. The rapid pace of regulatory change in the insurance industry, particularly concerning data privacy and cybersecurity, means that outdated or incomplete training can lead to significant compliance failures, reputational damage, and financial penalties. The core difficulty lies in disseminating complex information effectively to a diverse workforce with varying levels of technical understanding and access to communication channels. The correct approach involves a multifaceted communication and training strategy that leverages various channels and methods to reinforce learning and accommodate different learning styles. This ensures that the information is not only delivered, but also understood and retained. Specifically, combining a comprehensive written policy update with mandatory interactive training sessions, followed by accessible online resources and regular reinforcement communications, addresses the complexity of the topic and the need for demonstrable comprehension. This aligns with regulatory expectations for robust compliance programs that include effective training and communication, as mandated by frameworks like the NAIC Insurance Data Security Model Law and state-specific privacy laws, which emphasize the importance of employee awareness and adherence to policies. An incorrect approach that relies solely on a single email communication is professionally unacceptable. This fails to account for the volume and complexity of the information, the likelihood of emails being overlooked or misunderstood, and the lack of any mechanism to verify comprehension. Such an approach would likely violate regulatory requirements for effective training and communication, as it does not provide assurance that employees are adequately informed about their responsibilities regarding data security and privacy. Another incorrect approach, focusing only on a brief, optional webinar, is also deficient. While a webinar can be a useful tool, making it optional and brief for a critical topic like data security is insufficient. It does not guarantee attendance or engagement from all relevant personnel, nor does it provide a structured method for assessing understanding. This falls short of the proactive and comprehensive training expected by regulators. A third incorrect approach, which involves distributing a lengthy, technical document without any accompanying explanation or training, is equally problematic. While the document may contain all the necessary information, its technical nature and lack of context or interactive learning will likely lead to low comprehension and retention among many employees. This approach fails to translate complex regulatory requirements into actionable knowledge for the workforce, thereby undermining the effectiveness of the compliance program. Professionals should adopt a decision-making process that prioritizes a risk-based approach to communication and training. This involves identifying critical compliance areas, assessing the complexity of the information, understanding the target audience, and selecting communication and training methods that maximize comprehension and retention. The process should include mechanisms for verifying understanding, such as quizzes or acknowledgments, and a plan for ongoing reinforcement and updates. Question 15. Stakeholder feedback indicates that some underwriters are prioritizing speed in processing applications to meet ambitious production targets, leading to a less thorough review of applicant information and a greater reliance on automated risk assessments without sufficient human oversight. Which of the following approaches best aligns with regulatory requirements and ethical underwriting practices? Option A. Increase the reliance on automated underwriting systems, allowing them to make final decisions for a broader range of applications to expedite processing times and reduce manual review workload. Option B. Encourage underwriters to make quick, intuitive judgments based on their experience when faced with incomplete application information, prioritizing policy issuance over detailed verification. Option C. Develop new underwriting guidelines that explicitly allow for the use of broad demographic data to quickly categorize applicants and assign risk scores, thereby streamlining the assessment process. Option D. Implement a mandatory secondary review process for all applications flagged by the automated system as potentially high risk, and empower underwriters to conduct in-depth investigations for complex cases, ensuring decisions are based on objective risk factors and established underwriting guidelines. The correct answer is D. Implement a mandatory secondary review process for all applications flagged by the automated system as potentially high risk, and empower underwriters to conduct in-depth investigations for complex cases, ensuring decisions are based on objective risk factors and established underwriting guidelines. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient underwriting with the imperative to adhere to fair and non-discriminatory practices, as mandated by insurance regulations. The core of the challenge lies in interpreting and applying underwriting guidelines in a way that accurately assesses risk without unfairly disadvantaging protected groups. The pressure to meet production targets can create a temptation to streamline processes, potentially leading to the overlooking of critical risk factors or the application of subjective biases. Careful judgment is required to ensure that underwriting decisions are based on objective, actuarially sound principles, and not on prohibited characteristics. The correct approach involves a thorough review of the applicant's information against established underwriting guidelines, with a specific focus on identifying any potential red flags that might indicate a higher risk profile. This approach prioritizes a comprehensive risk assessment that is grounded in objective criteria. Regulatory justification stems from the fundamental principle of underwriting, which is to assess risk accurately and price it appropriately. This approach ensures that decisions are based on factors directly related to insurability and not on prohibited grounds, thereby complying with fair underwriting laws and ethical standards that prevent discrimination. An incorrect approach that relies solely on automated underwriting systems without human oversight is professionally unacceptable. This fails to account for the nuances of individual cases and can perpetuate biases embedded in the system's algorithms, potentially leading to discriminatory outcomes. Ethically, it abdicates the underwriter's responsibility to exercise professional judgment. Another incorrect approach that involves making assumptions about risk based on demographic data, even if not explicitly prohibited, is also professionally unacceptable. This circumvents the requirement for individualized assessment and can lead to unfair treatment. It violates the principle of underwriting based on specific risk factors relevant to the applicant, not on broad generalizations that may not apply. A third incorrect approach that prioritizes speed of processing over thoroughness, leading to the omission of key underwriting questions or the superficial review of applicant information, is professionally unacceptable. This approach directly contravenes the duty to conduct a proper risk assessment. It increases the likelihood of adverse selection and can result in policies being issued that do not accurately reflect the risk, leading to financial instability for the insurer and potential issues for policyholders. The professional decision-making process for similar situations should involve a commitment to understanding and applying underwriting guidelines rigorously. It requires a proactive approach to risk assessment, ensuring that all relevant information is gathered and analyzed objectively. When faced with complex or ambiguous situations, professionals should seek guidance from senior underwriters or compliance officers. The ultimate goal is to make informed, fair, and compliant underwriting decisions that protect both the insurer and the applicant. Question 16. Market research demonstrates that a new universal life insurance product is being designed with a strong emphasis on its potential for long-term cash value accumulation, particularly in a stable or rising interest rate environment. The marketing team plans to highlight these growth projections in their sales materials. As a certified insurance compliance professional, CICP, what is the most appropriate approach to ensure compliance with regulatory requirements concerning policy illustrations and consumer disclosures for this product? Option A. Rely on the marketing team's planned approach of highlighting the product's growth potential in sales materials, assuming that consumers will understand the inherent risks of universal life insurance and the illustrative nature of such projections. Option B. Focus on ensuring that the product's internal rate of return calculations are accurate and that these figures are prominently displayed in all marketing collateral, as this is the primary metric consumers will use to assess the product's value. Option C. Provide a basic disclosure statement that mentions the possibility of policy lapse, but does not elaborate on the specific factors that could lead to it, such as interest rate fluctuations or insufficient premium payments, to avoid overwhelming potential buyers with complex information. Option D. Develop and utilize policy illustrations that present a range of potential outcomes, including scenarios with lower than projected interest rates and the associated risk of policy lapse, and ensure these illustrations are accompanied by clear and prominent disclosures regarding policy funding requirements and the impact of economic conditions. The correct answer is D. Develop and utilize policy illustrations that present a range of potential outcomes, including scenarios with lower than projected interest rates and the associated risk of policy lapse, and ensure these illustrations are accompanied by clear and prominent disclosures regarding policy funding requirements and the impact of economic conditions. Explanation: this scenario is professionally challenging because it requires a compliance professional to navigate the complex interplay between product design, marketing, and regulatory disclosure requirements for universal life insurance, specifically concerning illustrations and the potential for policy lapse. The core challenge lies in ensuring that marketing materials accurately reflect the product's performance characteristics, particularly under adverse economic conditions, without misleading consumers. This demands a deep understanding of both the product's mechanics and the regulatory expectations for transparency and fairness. The correct approach involves proactively developing and utilizing illustration that clearly depict potential outcomes under various scenarios, including those with lower than projected interest rates, and ensuring these illustrations are accompanied by robust disclosures. This aligns with regulatory frameworks that emphasize the need for policy illustrations to be realistic, not misleading, and to adequately inform policyholders about the risks involved, especially the potential for policy lapse if cash values are depleted. This approach prioritizes consumer protection by providing a more complete picture of the product's long-term viability and the policyholder's responsibilities. An incorrect approach that relies solely on illustrations based on current or optimistic assumptions, without adequately addressing potential negative scenarios, fails to meet regulatory standards for disclosure. This can lead to policyholders making purchasing decisions based on incomplete or overly favorable information, potentially resulting in unexpected policy lapses and financial harm. Such an approach risks violating regulations that mandate fair and accurate representations of policy performance and the associated risks. Another incorrect approach that focuses on marketing the product's potential for cash value growth without equally emphasizing the risks of policy lapse due to insufficient funding or declining interest rates is also problematic. This selective disclosure can be considered misleading, as it omits critical information necessary for a prudent purchasing decision. Regulators expect a balanced presentation of both benefits and risks. A further incorrect approach that assumes policyholders will fully understand the nuances of universal life insurance and the implications of illustration assumptions without explicit, clear, and prominent disclosures is also a failure. Compliance professionals have a duty to ensure that information is presented in a manner that is easily understood by the average consumer, not just those with a sophisticated understanding of insurance products. The professional decision-making process for similar situations should involve a thorough review of product features, anticipated marketing strategies, and all applicable regulatory guidance. This includes understanding the specific requirements for policy illustrations, disclosure of fees and charges, and the communication of risks. A proactive stance, involving collaboration between product development, marketing, and compliance teams, is crucial to ensure that all materials are not only compliant, but also ethically sound and truly serve the best interests of the consumer. Question 17. Operational review demonstrates that the firm's current approach to ensuring suitability for investment recommendations primarily relies on advisor self-certification of adherence to internal guidelines and a post-transaction review of a small, randomly selected sample of client files. Which of the following approaches represents the most effective best practice for addressing potential gaps in suitability compliance? Option A. Focus on updating the firm's suitability checklist to reflect the latest product offerings, assuming that advisors will apply these updated checklists diligently. Option B. Implement a comprehensive program of ongoing advisor training on suitability requirements, coupled with a robust system for documenting client needs and a regular, independent audit of the entire recommendation process from initial client contact through to product selection. Option C. Develop a streamlined digital platform for advisors to quickly record client information and generate recommendations, thereby reducing the time spent on suitability assessments. Option D. Increase the frequency of post-transaction reviews to cover a larger percentage of client files and provide additional training to advisors on the firm's existing suitability checklists. The correct answer is B. Implement a comprehensive program of ongoing advisor training on suitability requirements, coupled with a robust system for documenting client needs and a regular, independent audit of the entire recommendation process from initial client contact through to product selection. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of suitability requirements, which are designed to protect consumers by ensuring that financial products and services recommended to them are appropriate for their individual circumstances. The core challenge lies in balancing the firm's business objectives with its fiduciary duty to clients, particularly when dealing with complex products or clients with evolving needs. Careful judgment is required to avoid misinterpretations of regulatory intent and to ensure that client interests remain paramount. The correct approach involves a proactive and comprehensive review of the firm's suitability policies and procedures, specifically focusing on how client information is gathered, assessed, and utilized in the recommendation process. This includes verifying that the firm's internal controls are robust enough to detect and prevent unsuitable recommendations, and that training adequately equips advisors to identify and address potential suitability red flags. This approach aligns with regulatory expectations that firms establish and maintain effective systems and controls to ensure suitability, thereby fulfilling their ethical and legal obligations to act in the best interests of their clients. An incorrect approach that relies solely on advisor self-attestation without independent verification fails to establish adequate oversight. This creates a significant regulatory risk, as it does not provide assurance that advisors are consistently adhering to suitability standards. The ethical failure here is the abdication of the firm's responsibility to supervise its representatives effectively. Another incorrect approach that focuses only on a sample of completed transactions, without examining the underlying processes and training, is insufficient. While it may identify some instances of non-compliance, it does not address the systemic issues that may lead to recurring suitability failures. This approach is procedurally weak and does not demonstrate a commitment to preventing future problems, which is a key regulatory expectation. A third incorrect approach that prioritizes the efficiency of the recommendation process over the thoroughness of client assessment is fundamentally flawed. Suitability is not a secondary consideration. It is a primary requirement. Prioritizing speed over client protection exposes both the client and the firm to significant risk and represents a clear ethical breach. The professional decision-making process for similar situations should involve a risk-based approach. Firms should first identify the key areas where suitability risks are most likely to arise. Then, they should implement robust policies and procedures designed to mitigate these risks. Regular monitoring and testing of these controls, coupled with ongoing training and supervision of advisors, are essential to ensure ongoing compliance and to foster a culture that prioritizes client interests. When reviewing existing processes, a comprehensive evaluation of both the design and the effectiveness of controls is paramount. Question 18. The monitoring system demonstrates a consistent collection of historical data related to soil and groundwater contamination at insured sites. However, it does not actively track emerging contaminants or changes in regulatory thresholds for remediation. Which approach best ensures compliance with environmental insurance policy obligations and relevant regulatory frameworks? Option A. Continue with the current historical data collection, as it accurately reflects past conditions and fulfills the basic reporting requirements of the policy. Option B. Focus the monitoring system solely on the most prevalent historical contaminants, assuming that emerging contaminants are unlikely to become a significant issue within the policy term. Option C. Enhance the monitoring system to include real-time tracking of emerging contaminants and proactive alerts for changes in regulatory remediation standards, aligning data collection with both policy terms and evolving legal requirements. Option D. Supplement the historical data with periodic, ad hoc environmental assessments, conducted only when a specific claim is anticipated. The correct answer is C. Enhance the monitoring system to include real-time tracking of emerging contaminants and proactive alerts for changes in regulatory remediation standards, aligning data collection with both policy terms and evolving legal requirements. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of how environmental insurance policies interact with evolving regulatory landscapes and the practicalities of environmental remediation. The compliance professional must not only interpret policy language, but also anticipate potential future liabilities and ensure that the monitoring system accurately reflects the insurer's obligations and the insured's compliance efforts. The challenge lies in balancing the need for comprehensive data with the cost-effectiveness of the monitoring, all while adhering to the specific regulatory framework governing insurance in the relevant jurisdiction. Careful judgment is required to ensure that the monitoring system provides actionable insights without creating undue burdens or misrepresenting the scope of coverage. The correct approach involves a proactive and integrated strategy that aligns the monitoring system's data collection with the specific terms of the environmental insurance policy and the applicable regulatory requirements. This approach ensures that the insurer and the insured have a clear and accurate understanding of ongoing environmental risks, the effectiveness of mitigation efforts, and the potential for claims. It prioritizes transparency and data integrity, which are fundamental to sound insurance compliance. Regulatory justification stems from the principles of fair dealing, accurate risk assessment, and the prevention of adverse selection, all of which are implicitly or explicitly supported by insurance regulations, designed to protect policyholders and maintain market stability. An incorrect approach that focuses solely on historical data without considering future trends or emerging contaminants would fail to adequately assess current and potential future risks. This could lead to underestimation of liabilities and inadequate reserves, violating regulatory principles of solvency and prudent financial management. Another incorrect approach that relies on generic monitoring metrics without tailoring them to the specific environmental exposures covered by the policy would render the data less useful for compliance and claims management. This oversight could result in non-compliance with policy conditions and regulatory expectations for diligent risk management. A third incorrect approach that prioritizes cost savings over data accuracy and completeness would undermine the integrity of the monitoring system. This could lead to misrepresentation of risk, potential coverage disputes, and regulatory sanctions for failing to maintain adequate oversight. Professionals should employ a decision-making framework that begins with a thorough review of the environmental insurance policy's terms and conditions, alongside an understanding of the insured's operations and the relevant environmental regulations. This should be followed by an assessment of the monitoring system's capabilities in relation to these requirements. The process involves identifying key risk indicators, determining appropriate data collection methods, and establishing a regular review cycle to adapt to changing circumstances. Collaboration with environmental consultants and legal counsel can further enhance the accuracy and compliance of the monitoring process. Question 19. The efficiency study reveals that the current method of distributing policy documents to new policyholders is time-consuming and costly. The company is considering implementing a new digital-first approach that involves providing a brief, high-level summary of policy benefits and exclusions via email, with a link to the full policy document hosted on a secure portal. This approach aims to significantly reduce printing and mailing expenses. Which of the following approaches best balances the company's efficiency goals with its regulatory obligations for transparency and explainability? Option A. Send a short email notification stating that the full policy document is available on the company portal, without providing any summary of its contents or highlighting key terms. Option B. Rely solely on the full, lengthy policy document, making it available for download but without any accompanying summary or explanation of its contents. Option C. Provide a concise, easy-to-understand summary of key policy terms, including significant benefits, limitations, and obligations, along with a prominent and easily accessible link to the complete policy document. Option D. Distribute only a brief, jargon-filled summary of policy benefits, assuming policyholders will only need this high-level information and will not require access to the full policy details. Correct answer is C. Provide a concise, easy-to-understand summary of key policy terms, including significant benefits, limitations, and obligations, along with a prominent and easily accessible link to the complete policy document. Explanation. This scenario is professionally challenging because it requires balancing the company's desire for operational efficiency with the fundamental regulatory obligation to ensure policyholders understand their coverage. The SIC designation implies a commitment to upholding these standards. The core tension lies in how to present complex insurance information in a way that is both concise for efficiency and sufficiently transparent for compliance and consumer protection. The correct approach involves developing clear, concise, and easily understandable summaries of policy terms and conditions, supplemented by readily accessible detailed policy documents. This aligns with the regulatory framework's emphasis on transparency and explainability, ensuring policyholders can make informed decisions. Specifically, regulations often mandate that policyholders receive information in a manner that is clear, conspicuous, and understandable. Providing summaries that highlight key benefits, exclusions, and obligations, while also offering a direct path to the full policy, directly addresses this requirement. This approach fosters trust and reduces the likelihood of disputes arising from misunderstandings, which is a key objective of insurance regulation. An incorrect approach that prioritizes brevity over clarity by omitting crucial details in summaries, even if it saves on printing or digital storage costs, fails to meet the transparency mandate. This could lead to policyholders being unaware of significant limitations or responsibilities, creating a compliance risk and potentially exposing the insurer to regulatory action for misrepresentation or failure to disclose. Another incorrect approach that relies solely on lengthy, jargon-filled policy documents without any form of summary or explanation fails to make information accessible and understandable. This can be seen as a deliberate attempt to obscure important terms, undermining the principle of explainability and potentially violating regulations that require information to be presented in a comprehensible format. A third incorrect approach that offers summaries but makes the full policy documents difficult to locate or access, such as burying them deep within a website or requiring multiple clicks, also falls short. This creates a barrier to understanding and can be interpreted as a lack of genuine commitment to transparency. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves first identifying the core regulatory requirements related to transparency and explainability. Then, they should assess proposed solutions against these requirements, considering the impact on policyholder understanding and the potential for misinterpretation. A robust process would involve seeking feedback from compliance officers, legal counsel, and potentially even consumer advocacy groups to ensure the chosen approach is both effective and compliant. The ultimate goal is to achieve operational efficiency without compromising the fundamental right of policyholders to understand their insurance contracts. Question 20. The evaluation methodology shows that following a significant cyber incident that compromised sensitive policyholder data, the compliance department is under immense pressure from senior management to restore all system functionalities immediately to minimize business disruption. The compliance officer is aware that a full security assessment and remediation of the vulnerability that led to the breach will take time. What is the most appropriate course of action for the compliance officer in this ethically challenging situation? Option A. Immediately restore all system functionalities to appease senior management, with a promise to conduct a security review and implement fixes retrospectively. Option B. Halt all system operations indefinitely until a complete and perfect security solution is implemented, regardless of the business impact. Option C. Delegate the decision-making authority for system restoration to the IT department, assuming they will prioritize security without direct compliance oversight. Option D. Advocate for a phased restoration of services, prioritizing systems with less sensitive data, while concurrently conducting a thorough security investigation and implementing necessary fixes before restoring access to highly sensitive policyholder information. The correct answer is D. Advocate for a phased restoration of services, prioritizing systems with less sensitive data, while concurrently conducting a thorough security investigation and implementing necessary fixes before restoring access to highly sensitive policyholder information. Explanation. This scenario presents a professional challenge because it forces a compliance professional to balance the immediate need for business operations with the long-term imperative of data security and regulatory adherence. The pressure to restore services quickly can create a temptation to bypass established security protocols, which could lead to severe regulatory penalties, reputational damage, and further data breaches. Careful judgment is required to ensure that the urgency of the situation does not compromise fundamental compliance obligations. The correct approach involves prioritizing the containment and remediation of the security incident, while ensuring that any temporary measures taken to restore services are done in a manner that does not exacerbate the data security risks or violate regulatory requirements. This means involving the appropriate security and IT teams, conducting a thorough investigation to understand the scope and nature of the breach, and implementing security controls before restoring access to sensitive data. Regulatory frameworks, such as those governing data privacy and cybersecurity in the insurance sector, mandate robust data protection measures and require prompt and effective responses to security incidents. Ethical obligations also demand that the company act responsibly to protect customer data. An incorrect approach would be to immediately restore full system access without a proper security assessment and remediation. This fails to address the root cause of the breach and leaves sensitive data vulnerable to further compromise, directly violating the duty to protect customer information and potentially breaching regulations that require timely incident response and data breach notification. Another incorrect approach would be to delay the restoration of services indefinitely due to fear of further breaches, without a clear plan for remediation and risk mitigation. While caution is warranted, an indefinite shutdown without a defined path forward can harm policyholders and the business, and may not align with regulatory expectations for business continuity and reasonable restoration efforts. A further incorrect approach would be to only focus on restoring the affected systems without investigating the broader security posture or notifying relevant parties as required by law. This reactive and incomplete response neglects the systemic issues that may have contributed to the breach and fails to meet regulatory obligations for reporting and comprehensive security improvement. The professional decision-making process for similar situations should involve a structured incident response plan that includes clear roles and responsibilities, communication protocols, and escalation procedures. Compliance professionals should advocate for a risk-based approach that prioritizes data protection and regulatory compliance, even under pressure. This involves understanding the specific legal and regulatory requirements applicable to the data involved, consulting with legal and cybersecurity experts, and documenting all decisions and actions taken. The ultimate goal is to restore operations in a secure and compliant manner, minimizing harm to all stakeholders.